Hello all. Time to do a comprehensive problem with cost volume profit analysis. Cost volume profit analysis is also known as CVP analysis and break-even analysis. All calculations begin with the contribution margin format income statement. Calculations are going to include break-even points, target profits, margin of safety, degree of operating leverage. The key pieces of data needed are the selling price, variable costs, and fixed costs. The results can be presented in tables or they can be presented graphically. Either way, they provide great input for decision making in a number of areas. So let's move forward. I'll show you how to solve this problem as well as provide insights on the key concepts involved. Cisco Corporation manufactures fans and has provided us with the following information. Selling price per fan is $120. Sales for the period totaled 30,000 units, or fans. Variable expenses were $84 per unit, or per fan, and fixed expenses total $900,000 per year. We will answer 7 questions using this data. Let's get started. The first question asks that we prepare a contribution margin income statement. I'm saving a little time by typing in the words, but sales is always going to equal your selling price of $120, and you're going to multiply it by the number of units sold. So to get the sales, it's always price times quantity. Variable expenses, same thing. The cost of our variable expenses, $84 a unit. We sold 30,000 units. Our variable expenses, $2,520,000. Underline it, subtract the 2, and you're going to get your contribution margin. Contribution margin is $1,080,000. These are the funds that are going to be used to cover fixed expenses and contribute to NOI. Our fixed expenses are a total of $900,000 a year. Again, we put a single line, subtract fixed expenses from the contribution margin. You get $180,000. That's your net operating income. We're done with. All right, let's move on to problem 2. Problem 2 says determine the break-even point in units and dollars. So when we calculate break-even, we're looking for the point at which net operating income equals 0. And we can calculate that in terms of the units of sales we need to break even or the dollars of sales revenue that we need to generate to break even. So let's first of all figure out the break even in units. We take our fixed expenses divided by contribution margin per unit. So here I'm going to point our fixed expenses, $900,000. Then I'm going to calculate my contribution margin per unit. Remember, the contribution margin per unit is the sales price per unit minus the variable expense per unit. So I'm going to take the 120, subtract the 84, and I'm going to get $36. So my contribution margin per unit, $36. I'm going to put a single line here to show that I'm dividing. I'm going to divide the 900,000 divided by $36, and I'm going to get 25,000 units. In other words, I need to sell 25,000 units in order to break even. All right. Next part of this problem says calculate the break-even point in dollars. All right, so the equation for break-even point in dollars is fixed expenses over the contribution margin ratio. Fixed expenses again are 900,000. The contribution margin ratio is the contribution margin divided by sales. So the CMR, you always take the contribution margin and you divide it by the sales. Now an alternative to that would have been to take the contribution margin per unit, which is $36, and divide that by the selling price and look at what you get, 30 as well. So either way, regardless of whether you take the total contribution margin and divide it by sale, or you take the contribution margin per unit and divide it by the selling price, you're going to get exactly the same answer. Okay, I'm going to underline that, and I'm going to do the division, and we're going to get $3 million. $3 million in sales is going to break us even. All right, now let me show you something here as well. Because if I would have taken the 25,000 units and multiplied the 25,000 units times $120 per unit selling price, I'm going to get 3 million as well. But you need to be able to do these calculations all three ways. Okay, so let's move this along. We're at number 3. We want to figure out the margin of safety in dollars and as a percent. So again, the margin of safety is going to be the actual sales that we have minus the break-even sales, and that gives our margin of safety. So in this problem, our actual sales were $3,600,000. We calculated our break-even point to be $3 million. So our margin of safety in dollars is the difference between what we sold and what we needed to break even. So again, the way this is interpreted is that sales could drop 600,000 and we would break even. If sales dropped by more than 600,000, we'd start losing money. Now you calculate margin of safety percentage by taking the margin of safety dollars and divide it by the actual sales. So again, the margin of safety dollars is 600,000. The actual sales, 3,600,000. I'm going to do the division, and I'm going to get 16.7%. So the way that's interpreted is that our sales could drop 16.7%, and we would still break even. If we have a sales drop greater than 16.7%, we're going to start losing. Our next problem asks us to compute the degree of operating leverage. The degree of operating leverage is a measure of how sensitive net operating income is to a given percentage change in dollar sales. All right, so you'll see how this works in a minute. So the degree of operating leverage is always the contribution margin over the NOI. So in our problem, we're going to say equals, and I'm going to point to the contribution margin. So having this statement done is critical to getting all these answers right. We're going to take the contribution margin as the numerator. The net NOI of 180 is the denominator. And you're going to divide the contribution margin by the NOI, and you're getting 6. That's a multiplier. Now that we've determined our degree of operating leverage to be 6, we can use that multiplier to determine projected future net operating income. In part 5, it says, if next year's sales are expected to increase by 6,000, what will be the expected percentage change in net operating income? And then ultimately, what is the expected total operating income for the next year? So to be able to do this stuff, you have to convert this 6,000 into a percent change. So if we're saying sales are going to increase by 6,000, we're going to put that 6,000 in the numerator, and then we're going to go to our original sales amount of 30,000, place that in the denominator, divide the two, and you're going to get 20%. So an increase of 6,000 units is equivalent to a 20% change in sales. Now, how do we use that number? To get the net operating income change, what we do is we take the 20% and we're going to multiply it by our degree of operating leverage of 6. And we're going to say if that takes place, our net operating income is going to increase by 120%. So in this case, if our sales increase by 20%, we can expect our net operating income to increase by 120%. The reason for that is, as sales increase, our fixed costs stay the same. So if we get a good increase of sales and we have a nice contribution margin, we're going to end up with a significant increase in our net operating income. Before I move on to the next part of this question, let me address this percent change, because in some problems, instead of saying next year's sales are expected to increase by 6,000, they'll say next year's sales are expected to increase to 36,000. Okay, so if we're saying that they're going to increase to 36,000, again, we have to figure out the percent increase. So what we do in this case is we take the 36,000, that's the current projection, we divide it by the prior period, that's the 30,000, and we subtract 1, and what do we get? We get exactly the same answer, 20%, because an increase of 6,000 units to 36,000 is a 20% change. An increase to 36,000 units instead of 30 is a 20% change as well. So you need to know this percent stuff both ways. All right, now having done that, the question is, what's the expected net operating income? The expected net operating income is always going to be your current income, which was 180,000, times 1 plus the projected change in income. So it's going to be 1 plus the 120, which is 220%. We multiply the two numbers, and we get 396. Bottom line here is that if we're projecting that sales will increase by 20%, and we have a degree of operating leverage of 6, then our expected change in net operating income is going to be 120%. That 120% change translates into a new total expected net operating income of $396,000. You need to be able to do all three steps. You need to be able to calculate a degree of operating leverage. And again, that's telling us how sensitive operating income is going to be to a given change in sales dollars. So then you need to be able to calculate the given change in sales dollars. But then once you do that, you'll be able to determine the expected change in net operating income on a percent basis, and then you convert that percent basis to an expected net operating income total for the following year. You need to be able to. Problem 6 and 7 deal with target profits. In problem 6, we're asking how many units have to be sold in order to make $450,000. In 7, we're saying what's the sales revenue needed to make $450,000 in profit. So the target profit unit formula is your fixed expense plus your target profit divided by your contribution margin per unit. So again, what we're going to do is we're going to say equals, and we're going to point up to fixed expenses, and we're going to add the target profit to it. So in this case, 450. And then we're going to put in our denominator our contribution margin per unit, which again was the $120 selling price minus the variable of 84 gives us 36. We divide the 1,350,000 divided by $36, 37,500 units have to be sold in order to make $450,000. All right, let's do the same calculation, but now we want to figure out what the sales revenue needs to be. So again, the numerator is exactly the same. It's the fixed expenses plus the $450,000. The denominator is the contribution margin ratio. And remember, the contribution margin ratio can be done two ways. Divide by the total contribution margin by the sales, or divide the contribution margin per unit divided by the selling price per unit. Either way, you're going to get 30%. We're going to divide, and we're going to get $4,500,000 in sales. If we sell $4,500,000 worth of goods, we're going to get a profit of $450,000. Again, another way to do this would have been to take the 37,500 units, multiply it by the selling price of $120 per unit, and we're going to get $4,500,000. All right, that takes care of the Cisco Corporation problem. I hope this stuff is making sense to you. Thanks for watching the video. Good luck.